The payment transaction, internal external payment transaction. Internal transaction is a business transaction which is not undertaken with any external third party. Then, the external transaction is a business transaction which is undertaken with one or more external third parties. Example of internal and external transaction. Internal transaction includes internal stock transfer from one department to another, charge of depreciation, amortization of prepaid expenses. The external transaction include third-party purchases or sale of goods, incurring of expenses. While both internal and external transaction have a monetary impact on the finances of the company. Through exchange of values occurs in external transaction as it involves exchange of resources between parties. Online and wired remittance. Online remittance, a transfer are the fastest way to send international payments. They are most commonly completed within one business day. Online transfer are also a very safe payment method, and transfers into accounts can be reversed in case of fraud. Wire transfer can involve physically going to a bank or credit union and filling out forms, especially for large payments. Wire transfer can also be sent over an internet banking website or through a company that processes wire transfer. The example of online and wired remittance. In 2015, Mexicans abroad sent more than $24 billion back home, which was more money than the country generated from selling oil. Payment system. A payment system is any system used to settle financial transactions through the transfer of monetary value. This includes the institutions, instruments, people, rules, procedures, standards, and technologies that make it exchange possible. Payment systems are indispensable to our life as individuals and to the smooth functioning of economy. They allow money to fulfill its role of accepted means of exchange when purchasing goods or services. The example of payment system are cash, checks, debit cards, credit cards, mobile payments, and electronic bank transfers.
Hi guys, I'm Vianca Ocampo, and now I will discuss to you about the modern payments of transaction, PhilPass or Philippine Payment and Settlement System, and lastly is the real-time gross settlement system. So let's proceed. First is the modern payment of transaction. It means that the modern payment system uses cash substitute as compared to the traditional payment system. This includes debit cards, credit cards, electronic funds transfer, direct credits, direct debits, internet banking, and e-commerce payment system. For example, a woman goes to grocery but she ran out of cash. Luckily, she has her credit card with her, so she was able to pay her grocery using the card. This cashless payment is considered the modern payment. The next one is the PhilPass or the Philippine Payment and Settlement System. PhilPass or Philippine Payment and Settlement System is the payment policy used by banks in settling their interbank payment transaction. The payment is initiated by paying banks to the transmission of the electronic instruction to transfer funds from their respective demand deposit account or the DDA to the DDA of the payee bank. The best example for this is when you want to buy a property and you use the check to bought it by the seller. And lastly, real-time gross settlement system. Real-time gross settlement system or RTGS are specialist fund transfer system where transfer of money or security take place from one bank to another on a real-time and on gross basis. Real-time gross settlement system do not require an actual physical exchange of funds. A central bank will often adjust to account of the sending and receiving bank in electronic form. For example, sender bank A's balance will be reduced by $1 million, while recipient institution bank B balance will be increased by $1 million.
Remittance process. Remittance happens via a legal channel, mail, bank transfer, money order, or unauthorized money transfer operator. The remitter or expatriate transfer the funds from the current country of residence to their family back home. Remittances play a massive role in the financial ecosystem today, and if your business needs to send or receive payments, it's important to understand how they work. Here's what you need to know. For example, a remittance is the transfer of money from one account to another, generally for service rendered. The amount of money being sent internationally has increased massively in recent years, mainly due to more businesses working with customers and clients overseas. Another huge factor is economic migration. With continuous increase in people working abroad comes an increase in the amount of money people send back to their families and friends. Payment and remittance processing. Payment processing is how businesses complete credit card and debit card transactions. Payment processing services expedite card transaction and payment gateways securely transmit data so money from a customer issuing bank can be transferred to a merchant's account. When it comes to payment processing, the word remittance is primarily described as a mailed-in payment towards goods purchased or services rendered. A remittance processing system is an automated system that handles and processes your mail-in remittances, payments like checks, tasks, lease payments, etc. They collaborate between all parties involved to make the payment processes efficient and seamless for the merchants and customers. Payment processing services are the ones who fulfill a number of steps required from authenticating to settling a transaction. These transactions mainly include payment methods such as credit cards, debit cards, and e-wallets, and etc. International investment. International investment is one of the investment strategies in which an investor diversifies his portfolio by purchasing various financial instruments like shares, mutual funds, etc., or investing to acquire ownership or collaboration in different companies across the globe in order to maximize the return and to reduce their exposure to various investment risks. International investment provides an opportunity for investors to capitalize on the good performance of the foreign economy if their domestic economy's performance is relatively bad. These investments are mostly driven by the macroeconomy of the country, and most investors focus on the emerging economy. We have two types of international investment. On the basis of the use of investment, foreign investments are classified into two categories: foreign direct investment (FDI), foreign portfolio investment (FPI). 1. Foreign direct investment. FDI is an investment when the investors invest in a business situated on foreign land in order to acquire ownership or collaboration. 2. Foreign portfolio investment (FPI). FPI is an investment made in a foreign economy by an investor with no motive to gain any role in the management of any organization.
How correspondents work. Correspondents are bank representatives who help villagers to open bank accounts. Business correspondents get commission from bank for every new account opening, every transaction made by them, and every loan application processed. They collect small deposits, sanction loans, and perform other basic banking services without the need to set up a bank branch. Example activities done by correspondents are deposit money in behalf of client's account, take money out of savings account in authorization of the owner, and process loans. On international transaction, correspondence also has a role. Here is a sample common transaction. A local bank customer wants to pay for product purchased from foreign suppliers. So, there will be a correspondent bank that will facilitate the transaction because they have access to do so. The Cash Compliance Reports. In accordance with the Anti-Money Laundering Act, which is the Republic Act 9160, the Act aims to protect and preserve the integrity and confidentiality of bank accounts. It is to ensure that the Philippines shall not be used as a money laundering site for the proceeds of any unlawful activity. The compliance report shall be done when there are transactions that are covered and suspicious that involves a huge amount of money. This is to ensure that money is not used for finance terrorism or laundering. For example, there is a transaction that has a total amount of 4 million pesos, can be local or foreign currency, and the purpose of transaction is unclear, unreliable, and suspicious. There is even no obligation or valid legal contract. Therefore, this is subject for cash compliance report. The account, transaction, and money will be frozen, and those who are involved had to explain their legal sides so that the freeze order will be lifted. Failure to explain or being caught as laundering will be subject to facing legal penalties with fine or imprisonment. The risk management and internal control. The purpose of internal control and risk management is to ensure that the company's operations are effective, that financial and other information is reliable, and that the company complies with the relevant regulations and operating principles. Risk management and internal control perform regular assessments to ensure appropriate reporting, risk management, integrity, ethical business conduct, and compliance with laws and regulations are all in place. The effective way of identifying misstatement on financial reports. When this is properly exercised, the company will be able to prevent fraud or reduce errors such as assets being stolen or lost, recorded payment without an actual purchase, and manipulated cash transactions.
Bank reconciliation. Bank reconciliation is a statement which brings into agreement the cash balance per books and the cash balance per bank. It is usually prepared monthly because the bank provides the depositor with a bank statement in the end of the month. Example of bank reconciliation. Reconcile cash per books and cash per banks. Cash per books, basically it is in the record of the clients. Cash per banks, basically amount of cash in the bank statement. You need to reconcile the cash per books and cash per banks because they are not balanced. The reason is because of the reconciling items, timing differences. Bank reconciliations report that explain the difference between the book company balance of cash and the cash balance reported on the bank statement for purposes of computing the adjusted cash balance, usually bank statement. Forms of bank reconciliation. Adjusted balance method. The bank and book balance are brought to a correct cash balance that must appear on the balance sheet. Book-to-bank method can include transactions that have yet to settle or clear through the bank account. At the end of accounting period, a company's book balance is reconciled with the bank balance via the monthly bank statement. Bank-to-book method. It begins with the bank's balance into a company's or individual's records and adjusts it accordingly in terms of deposit, checks, or other withdrawals. Systems and audits. In a systems and audits of efficiency, the focus is on the management systems and practices, including systems of internal control used by an organization to achieve, maintain, demonstrate, and improve the efficiency of its services or operations. System and audit is defined as a systematic and independent examination to determine whether activities and related results comply with the planned arrangement and whether these arrangements are implemented effectively and are suitable to achieve objectives.